Okay, so what we're going to do, we're going to work through this FAC3762 exam paper. In this session, I'm going to work through question 2, which is the leases question. So the idea over here is we're going to read through the scenario and then we will answer the question. As we answer the question, what will happen, I will explain the important concepts. We will also make sure that we work through I-4016 as well. I have I-4016 open, and I'll share with you how we identify the various aspects. Okay. So I'm going to go to question 2, which is a leases question. Okay, so here we go. So they say Turner Industrial is a company that operates in the commercial drill manufacturing industry, selling drilling equipment to end users. The financial year in of the company is 31 December. Okay, so we know that Turner sells drilling equipment to end users, and our financial year is 31 December. So that means we have 1 Jan to 31 December. So in a leasing question, it's important to identify who is who, who's the lessee, who's the lessor, so that we can apply the correct accounting principles. Okay, so they say due to tough economic environment, rising interest rates and competition in the industry, Turner had been struggling to increase sales, which resulted in profit margins falling. The financial director structured lease deals that will be competitive in the market to increase sales. On 1 January 2021, Turner entered into an agreement in which Turner leased an all-geared extra heavy-duty radial drill to Impact. The lease agreement contains a lease in terms of I-4016 leases. Okay, so now it's important to understand what's happening over here. So we know on 1 Jan, that means it's the beginning of a financial year. Okay. Turner entered into a lease agreement with Impact. So Turner and Impact are the two parties. And Turner is the lessor and Impact is the lessee. So it all depends on whose books we are looking at. Okay, so that's very important to understand. So in this lease agreement, Turner is leasing Impact a drill, okay, a heavy-duty radial drill. Okay, so just take note of that. So they say the terms of the lease are as follows. Commencement date, 1 January 2021. Okay, the lease period, it is 3 years. And then we have lease payments, which is 80,000 Rand paid in advance on 1 January of each year. So that means 1 January 2021, 1 January 2022, 1 January 2023, there will be a payment of 80,000 Rand each, which is basically a total of 81624, 240,000 Rand. Okay, then they say a guaranteed residual value, 10,000 Rand payable on 31 December 2023. The only thing that is, okay, so a guaranteed residual value. So that means on 31 December 2023, Impact has to pay Turner an amount of 10,000 Rand. Okay, that's a guaranteed residual value. Okay, interest rate as quoted. Okay, so this is the quoted interest rate, 18%, and then legal fees incurred by Turner, 5,000 Rand. Very important to identify who is incurring these direct costs. So it's called incremental direct costs. So an incremental direct cost is a cost incurred as a result of the lease. Okay, if we did not enter into a lease, we would not have incurred legal fees. Okay, so the legal fees only arising as a result of the lease, so that would be considered a direct cost. Okay, so the question you need to identify is who's incurring the direct cost. Is it the lessor, Turner, or is it the lessee, Impact? In this case, it is the lessor, Turner. Okay, that's very important. The ownership of the asset will pass to Impact at the end of the lease term at no cost. Okay, very important. So one of the conditions for a finance lease is if the ownership of the asset is transferred to the lessee at the end of the lease term, then from the lessor's perspective, it is most likely a finance lease. Okay. So then they say the drill was manufactured at a cost of 180,000 Rand. The normal selling price of the drill is 210,000 Rand, and the fair value is 235. The economic life of the asset is 4 years. The market-related interest rate for similar lease agreement is 22%. So here you can see they charging 18%, but the market rate is 22%. Okay, so just take note of that. So let's have a look what the question is asking. So they say, in part A, discuss the classification of the lease in the accounting records of Turner. Okay, so here you must understand now whose books are you looking at? Are you looking at Turner or are you looking at Impact? So we're looking at Turner's books. Who is Turner? Turner is the lessor. Okay, so from a lessor perspective, a lease could either be an operating lease or a finance lease. Okay, so the way you determine is you must first determine whether it is a finance lease or not. If it is a finance lease, then we will classify it as a finance lease. If it is not a finance lease, then automatically it becomes an operating lease. So from a lessor perspective, you must first do the classification. Okay, so the classification, you must test for whether it is a finance lease. And if it's not a finance lease, only then does it become an operating lease. If this was in the books of Impact, then that means we're looking at from the lessee's perspective. From a lessee perspective, it will always be we will always classify it as a if I can call it in inverted commas, a right of use a finance lease, which is basically a right of use asset and a lease liability. Only in two exceptional circumstances that it will be an operating lease. Okay, so just take note of that. So we're dealing with a lessor, so we'll have to go through the criteria to determine whether or not it is a finance lease. And I'm going to use IFRS 16 to show you what are the criteria, and then we will try to answer it based on that. Okay, then we have part B. Assuming that the lease is classified as a finance lease and a dealer lessor, prepare the journal entries to account for the lease in the accounting records of Turner Industrial for the year ended 31 December 2021. Okay, so I'll take you through the thinking regarding this. I'll show you two, before we actually answer it, I'm going to show you two distinct things to think about and how we do it if it was those distinct items, and then we will combine them to show you how to do the journals regarding this particular question. Okay, so let me share. Okay, so let me share. Okay, you see IFRS 16 in front of you? Yes, no?
Yes.
Okay. So here we have IFRS 16, the classification of leases for a lessor. Okay, so we will apply paragraph 63, and you can also apply paragraph 64. Okay, so those are the two paragraphs. I'm going to read through it, and then we will apply to the scenario. So they say in paragraph 61, a lessor shall classify each of its leases as either an operating lease or a finance lease. Okay, so that is what they're telling you. You have to classify if you're a lessor either as a operating lease or a finance lease. Now, If you go to Appendix A, right? In Appendix A, for the new standards. So whenever it's an IFRS, that is a new standard. IAS is the old standards, okay? So when you see an IFRS standard, you'll have the normal standard, you'll have Appendix A, you'll have Appendix B, and there may be other appendices as well. So the normal standard will just be the general principles. Appendix A will always be the definitions. Appendix B, that is known as the application guidance. So that takes the normal standard and explains it a little bit more in detail. Okay, so here you can see paragraphs B to 58. So for classification of leases, you want further details of the application of these standards, you look to B53 to B58 meanings, Appendix B, paragraph 53, and paragraph to paragraph 58. So IAS will just be a standard in its totality, right? Well, explaining stuff, the normal standard, and the definitions. Whereas the I4S standards follow the approach. They have the standard, and if I can call it the normal standard, so it's quite summarized. I'm just giving you the key principles. If you want to understand the key principles further, you look to Appendix B, which is the application guidance. And in big standards, I always tell you, read the application guidance because a lot of the answers are there. And then Appendix A will always be the definitions. So with the I4S standard, what constitutes the standard is, if I can call it, the normal part, Appendix A and Appendix B. Okay, so that constitutes the standard. That's very important on a CTA level to know what constitutes a standard and what is just additional information. So just take note of that. But we're not going to go into that detail now. Okay. So they say a lease is classified as a finance lease if it transfers substantially all the risk and rewards incidental to ownership of an underlying asset. Okay, so what is the underlying asset for us? It is that drilling, that expert drilling thing. Okay, so it will be a finance lease if basically all the risk and rewards of ownership is transferred from the lessor to the lessee. Okay, a lease is classified as an operating lease if it does not transfer all the risks and rewards of ownership of the underlying asset. So what is trying to tell you? An operating lease is only an operating lease if it is not a finance lease. So therefore, we first identify whether it is a finance lease or not to establish the classification of a lease. So whenever you have to classify a lease, you must go through the criteria of a finance lease. Okay, so they say whether a lease is a finance lease or an operating lease depends on the substance of the transaction rather than the form of the contract. And the reason for this is many people would come up with draw legal terms, and they would in legal form it will say it's an operating lease. Okay, so it will the contract will say lease agreement between Impact and between Turn and Impact, and the lease is an operating lease. So in legal terms, it will state that the lease is an operating lease. But that is why accounting is saying, don't look at the legal form of the contract. Look at the terms, look at the substance, which means look at the terms and conditions of the contract. So in legal form, it may state that the lease is an operating lease. But if you look at the terms of the contract, which is the substance of the contract, it will actually be a finance lease. And that is why the accounting standard makes it clear, because before this clarity, companies would get lawyers to draw up lease agreements and simply call it an operating lease. But if you look at the terms and conditions, it is basically a finance lease. And that is why accounting has always been on the view of substance over form. Okay, so they say examples of situations that individually, so either one of them or in combination, would normally lead to a lease being classified as a finance lease. Okay, so we'll always look to these 5 criteria over here. So take note, if one of these criteria is met, then it is a finance lease. So it doesn't have to meet all 5. It just needs to meet one of them. Okay. So number 1 or number A, the lease transfers ownership of the underlying asset to the lessee by the end of the lease term. Crystal clear in the contract. Okay. So let's quickly open up Excel so we can answer this question. What do you see in front of you? Excel or IFRS 16?
Excel.
Excel. Okay, perfect.
Yeah.
Okay, so let's go to answer the question quickly. Okay, so the question is saying, discuss the classification of the lease in the accounting records of Turner Ltd. Okay, so this is for FAC3762. FAC3762 October, November 2022 exam. Okay. Question 2. Okay. Part A. Okay, so they say discuss in the books of Turner whether it is a finance lease or an operating lease. Okay, so I'm just writing this information. Not all of it will be relevant. So Turner is the lessor in the contract. Okay. Okay. So in terms of IFRS 16, the lessor must determine whether a lease constitute a finance lease or an operating lease. Okay, so okay, a finance lease a lease is a finance lease if substantially all the risks and rewards incidental to ownership of the underlying asset is transferred from the lessor to the lessee. Okay, an operating lease, a lease is, okay, I'm going to say that a lease is an operating lease if how do I put this now? A lease, an operating lease, if substantially all owners and ownership is not transferred. Okay, so basically you're just stating to them, you're giving them some background. This would probably bring you 1 mark max. Okay, so what we wrote so far probably bring you 1 mark max. Now, so now we'll say finance lease would meet 1 for all of the following criteria. Okay, so remember, you get no marks for stating the criteria. You must link it to the scenario. Okay, you need to link it to the scenario. Okay, so So we can actually say the lease between Turner and Impact is a finance lease because. Okay, so now we can state so now we know it is a finance lease. We already read and met one of it. But now remember what the question told us over here. The question says, as far as possible. Okay, so therefore, in a normal question, if it wasn't a discussion, you could have just said the lease is a finance lease because of the asset is transferring to Impact at the end of the lease term. That's sufficient. But they said we must discuss it in as far as possible given the scenario. Okay, so we'll go through it one by one. So if I look at the first one, the lease transfers ownership of the underlying asset to the lessee by the end of the lease term. Okay, so we will say you literally just copy and paste this thing over here. Okay, so we'll copy that. Okay, so that's one. Now we'll look through another item. So we got that first part. So we already know it is a finance lease because it meets one of the criteria already. Because remember it says it will be a finance lease, example of situation that individually or in combination would lead to a finance lease. Any one of this already meets one of it. So we actually know it's a finance lease. But the question told us, discuss it as far as possible in terms of the scenario. So that's why we can go through all five. Okay, so they say the lessee has the option to purchase the underlying asset at a price that is expected to be sufficiently lower than the fair value at the date the option becomes exercisable for it to be reasonably certain that at the inception date that the option will be exercised. Okay, so we can say over here, there is no option to purchase the asset, but the asset is, but the ownership of the asset is being transferred at no cost. Okay, so that's it. So there's no need for that, for the option to be there, because if the ownership is transferring, then you understand that the next clause is not important. If perhaps there was a price for the ownership to transfer, okay, then we'd have to assess whether the lessee would actually exercise that option. Okay, so there's no need because the cost is zero. The lessee will take it. Okay, so the ownership is transferring. Okay, this one is not necessarily important because there is no option to purchase, but we do know the ownership is transferring to the lessee at a zero cost. If the ownership was going to transfer to the lessee at a cost, then we'd have to consider whether that cost is below fair value at that time when it will transfer. Okay. So the lease term is for the major part of the economic life of the underlying asset, even if title is not transferred. Okay, so now we need to assess over here. So let's have a look. If we go to the scenario, the lease term is 3 years. The economic life, where did I see that? The economic life of the asset is 4 years. That is 3 out of 4, in percentage is 75%, but 3 out of 4 years is substantial. Okay, so then we will say, if we go back, what standard says for the major part of the economic life. Okay, so we will say the lease term of the underlying asset is 3 years while its economic life is 4 years. Okay, this is a major, what do they call it? That is a major part. Okay, so we will just say that this is a major part of the economic life of the underlying asset. Okay, so that is basically what we are saying over there. The next one we're going to look at the inception date, the present value of the lease payments amounts to at least substantially all of the fair value of the underlying asset. Okay, so let's have a look. So the fair value of the asset is 235. The drill was manufactured at a cost of 180. The normal selling price of the drill is 210, and the fair value is 235. Okay, so let's have some workings over here. Fair value of the underlying asset, 235. Okay, given. Present value of lease payments. We need to work that out. Okay, so let's have a look. What is the definition of present value of lease payments? So this is important to take note. So let's go have a look. Okay, so we need to work out this one. This one will always be, you'll always have to work out this one. Just quickly read part E. The underlying asset is of such a specialized nature that only the lessee can use it without major modifications. I am not 100% certain. So it's definitely a specialized nature. Okay. So let's just see whose impact quickly. Due to Eichner, okay, struggling, okay, Turner, lease, and all get heavy duty to impact industries. The lease contains, okay. They're not saying whether the drill is special. It is definitely specialized, but perhaps there are other companies that can use that drill. So we're not 100% certain. Okay, so let's quickly answer part E. The underlying asset is such of a specialized nature that only the lessee can use it without major modifications. Okay, so let's actually go write that down. So we'll say the asset is of a specialized nature. However, it is not clear whether only impact will be able to use the drill. Okay, so we're just stating that. So this one does not apply. Okay, so the last criteria E does not apply. Why? The asset is of a specialized nature, no doubt, but it's not of such a specialized nature that only, however, it's not clear whether the asset is of such a specialized nature. However, the asset is however, it is not clear whether the asset is of such a specialized nature that only impact will be able to use the drill. Okay, so we are stating that the last criteria does not apply. But the last one we need to go to work out is the fair value. So you can see the little information, because a lot of that 11 marks, probably half of the 11 marks is going to come about to calculate the present value of lease payments. Very important that you're able to calculate the present value of lease payments. Okay, so now we're going to focus on this one. At the inception date, the present value of the lease payment amounts to at least substantially all of the fair value of the underlying asset. So let's go and work out. So let's first go look at the definition of the present value of lease payments. Okay, so it's going to be a back and forth to go through that. So let me just go to Appendix A. Go to Appendix A, which is okay, so Appendix A is defined terms. Okay, so we are to look at present value of leased payment. Now it's starting to look at lease payments. So let's have a look what's the definition of lease payments. Okay, so we're on the present value of lease payments. We did see lease payments here now. Okay, so here we must, so it's very important to understand what is included in lease payments. So they say payments made by a lessee to a lessor relating to the right to use an underlying asset during the lease term, comprising the following. So when you want to work out the present value, one of two ways, right? Using Excel, using your financial calculator. Okay, so I'm going to use Excel. You could use your financial calculator. But either way, when you work out a present value, there's one of two ways of doing it. You either use that 5 buttons on your financial calculator, right? Or you use the cash flow function. You can only use that 5 buttons on the financial calculator if everything is consistent, right? Whereas the cash flow, when you use the cash flow function, you can use it anytime. Okay, so it's important to know when you can use the 5 buttons on your financial calculator, but you must also know the cash flow function can be used anytime in either circumstance. So I'll show you both ways so you can see when not to use. Okay, so remember, the lease payment is made up of 4 things. Fixed payments. So it is a fixed payment, less any lease incentive, very important. There's no lease incentives in this question. Okay, variable lease payment that depends on an index or a rate. There's no variable lease payment that depends on an index. Okay, we have a fixed payment, but we don't have variable payments. Okay. And then number C, the exercise price of a purchase option if the lessee will take it. So we know there is no exercise price. But if there was an exercise price, it does not mean it must be included. You will only include it if it is reasonably certain that the lessee will make use of that option. When is it reasonably certain? If the exercise price at the end of the lease term is lower than the fair value at the end of the lease term. Okay, then payments of penalties for terminating the lease. If the lease term reflects the lessee exercising an option. Okay, very important. Okay, but now there's some more stuff you must read over here. For the lessee, lease payments also includes amounts expected to be payable by the lessee under residual value guarantees. Okay, so a guaranteed residual value. Lease payments do not include payments allocated to non-lease components. Okay, so that's important. Take note. The lessor includes. Okay, so we're not going to worry about that. Okay, so if there is a the lease payment will include. So just take note of that. So let's have a look. Let's see what was this. For the lessor, lease payments also include any residual value guarantees to the lessor by the lessee. Yeah, okay, so we have that. Okay, so that's very important to take note. So let's have a look. I'm gonna do an Excel. I'm gonna do a cash flow calculation. So remember, we have year 0, we have year 1, year 2, year 3. Okay, so what can be included? Fixed lease payments. Okay, fixed lease payments can be included. What can also be included? Variable lease payments, okay, linked to an index. There's nothing on this one, okay, but we're just putting everything in. What can also be included? Exercise purchase option, okay. What can be included? Termination penalty. So if there is a termination penalty, it does not mean the termination penalty must be included. You will only include the termination penalty if there is a termination penalty and if it is reasonably certain that the lessee will cancel the lease, okay, or terminate the lease before the end of the lease. And then a guaranteed residual value. Okay, so that is basically what you will include in a lease payment. Okay, so important take notes on this scenario. There is a fixed lease payment of 80,000 Rand. Okay, what's important to take note? It is annually in advance. The important aspect here, in advance. Okay. So what you must understand, this is the same principle in MAC, financial management, that the columns over here represents the end of the year. So if you put something in year 1, you are saying the cash flow takes place at the end of year 1. If you put something in year 2, you are saying the cash flows is taking place at the end of year 2. Okay, very important, take note. So if something happens at the beginning of year 2, you can't put it into year 2 because year 2 happens at the end of year 2. So something that happens at the beginning of year 2 will take place in year 1 because the end of year 1 is the same as the beginning of year 2. Very important. So therefore, because some stuff is happening in advance, the lease payments will start in year 0. Okay, so 80,000 Rand. So this is happening at the beginning of year 1. So therefore, we put it into year 0. This one over here, happening at the beginning of year 2. Therefore, we put it into year 1. This one over here, happening at the beginning of year 3. Therefore, we put it into year 2. Okay, so just take note of that. Very important. Okay, there's nothing over here. So go 0, 0, 0, 0, 0. Okay, no exercise price. Okay, you don't have to put in zeros. I'm just putting it to demonstrate 0, 0, 0, 0. So for stuff that have 0, there's no need to put this in. I'm just putting it in here to demonstrate all the aspects that impacts the present value of lease payments. Okay, and then we have a guaranteed residual value. The guaranteed residual value, 10,000 Rand payable on 31 December 2023. Okay, so remember, if I put a date over here, because year 1 represents the end of year 1, year 1 would be 31 December 2021. Year 2 would be 31 December. Year 2 would be 31 December 2022. Year 3 would be 31 December 2023. Okay, so take note of that. So therefore, they're telling us the guaranteed residual value of 10,000 Rand will happen on 31 December 2023. So we put it in year 3 because year 3 represents the end of year 3. Okay, so take note of that. So year 0 is basically 31 December 2020, or you can use the actual scenario, which is 1 January 2021. 31 December 2020 is the same thing as 1 January 2021. Okay, so just take note of that. So that is all the cash flows that is happening. I skip a line usually because if I missed something, it's easy for me to insert it. So that is cash flows. Okay, and then I need the discount rate. Okay, and this will give me discount rate. Okay. So Excel works a little bit different as I'm doing this. This here is present value. Okay, and this will give you so I'll explain that now. Okay, so we'll deal with that now. Okay, so now all we need over here is the discount rate. So once again, that is why there's 11 marks. You can see over what we wrote over here is not worth 11 marks. Why? Because this calculation over here is probably 5 to 6 marks. Okay, so to get the present value of the lease payments is probably 5 to 6 marks, half of the question. So the discount rate, there's also a definition of what the discount rate is. So we need to work out the discount rate. So what most people would have done, is use that 18%. We can't use that 18%. Okay, so we will go and work out the discount rate. So let's go and have a look. Okay, so I'm going to take you back to I-4016 and look at the implicit rate in the lease. Okay, so I think it's above here. Okay, so this is the rate we need to use. Interest rate implicit. Interest rate implicit in the lease. Okay, so they say the rate of interest that causes the present value of the lease payment and the unguaranteed residual value to equal the sum of the fair value of the underlying asset and any initial direct costs of the lessor. Okay, so now we need to work out the what we're trying to work out. We need to work out the interest rate implicit in the lease. So what is the interest rate implicit in the lease? It is the rate that causes the present value of the lease payments and the unguaranteed residual value to equal the sum of the fair value of the underlying asset and any initial direct costs of the lessor. So the way we'll work this out is using the financial calculator, those 5 buttons, but it's be able to slot in those numbers. Okay, so I'm going to put in over here working 2. Okay, so this here is working 1, working 1, working 2. What do we want? We want the interest rate implicit in the lease. We want the interest rate implicit in the lease. So we want I. Okay. So we want I. That's what we want, I. In order to get I, we're going to need the other four numbers: present value, future value, PMT, and N. Okay, so we're going to need present value, future value, PMT, and N. Okay, so the present value is basically the fair value minus initial direct costs. Okay, fair value less initial direct costs. Okay, so I'm going to check something quickly. It's an important aspect. So remember, it is any initial direct costs incurred by the lessor. If that 10,000 Rand was incurred by the lessee, we don't take it into account. If the initial direct cost is incurred by the lessor, only then do we take it into account. Okay, so that's very important. So therefore, this is going to be equal to 235 minus 235 minus, I don't know what I saw now. The initial direct cost is 5,000. Okay. 235 minus 5,000. Okay, so the present value is fair value less initial direct costs. Okay, so interest, it is the fair value of the underlying asset and any initial direct cost of the lessor. Okay, so we took into account the fair value 235, and we took into account any initial direct cost by the lessor. If that 5,000 Rand was incurred by the lessee, then this would have been, then the direct cost would have been 0. Okay, very important. Unguaranteed residual value, there is no unguaranteed residual value. Okay, if there was an unguaranteed residual value, in most cases, the unguaranteed residual value would happen at the end of the lease term. Then you would put it in over here. Okay, so this here is unguaranteed residual value. If to be paid at end of lease term. Okay, so remember, they call it a residual value. So a residual value happens at the end of something. Okay, so that is why it will generally always be over here, because the residual value only happens at the end of whatever it is. In this case, what is the end? The lease term. So a guaranteed and an unguaranteed residual value will take place at the end of a lease term. Okay, so just take note of that. I'm going to look at clarify one more thing. So the guaranteed, so the rate it causes the lease payment and the unguaranteed residual value to equal to the sum of. Okay, so therefore there's no unguaranteed residual value. Now we must take into account the lease payments. Okay, now we need to take into account the lease payments. Okay, so very important, take note of that. So now remember, what are the lease payments? This is the lease payments. Okay, so that's important to be aware of. This is the lease payments. So that is important to take note. So the complication over here is as follows. Okay, so your payment is your fixed lease payment, which is 80,000 Rand. Okay. And then over here, this will also be because we must take into account the all lease payments, which is the guaranteed residual value as well. So remember, if there was an unguaranteed residual value, must put it in here, but there is nothing. But we're also taking into account the guaranteed residual value, because when does the guaranteed residual value happen? At the end of the lease term. What is your fair value? This FV is future value. Future value is the last payment at the end of the term, at the end of 3 years. Okay, so very important, take note. N is the number of payments, which is 3. So therefore, we can work this out. Rate equals, rate open. We want N, we want PMT, we want present value, we want future value, we want type. End of the period or beginning of the period. Okay, so the payments is beginning. Okay, so remember it was beginning. Remember, just make a guess. Okay, so what I'm going to make a guess is 10%. I'm just making 10%. Okay, so when I close this, it's not going to work out, and I'll tell you why. Okay, so give me an error. Why? Because remember, future value and PMT must be in the same direction, and present value must be in the opposite direction. Okay, so what I'm going to do, I'm just going to make this negative. Okay, so there we go. So the rate implicit in the lease is 8%. Okay, seems very low. But okay, let's go with 8%. I don't now can't check a solution to see if it's correct. Okay, so that is 8%. Okay, so now we can work out the discount rate. So to work out the discount rate, it will be NPV. Okay, so here you can see the rate is 8%. Look at the formula of NPV. It starts from value 1. So we have to start from value 1. Okay, so it's giving us 150,000 Rand. So just take note of that. But we must bring in cash flow year 0. So on a financial calculator, this answer over here would have included everything. Because if you use a financial calculator, it starts from cash flow 0. But if you use Excel or Google or Google Sheets, it's going to start from year 1. So you must have a separate line item for year 0. Okay, very important. Okay, so this is going to be total present value. So if I work this out, works exactly like it basically works substantially like, so the fair value is 235, the present value of the lease payments is 230, so it is substantially all of the fair value. Okay, so we can answer that question. If we go back to lease, to the classification of a lease. So we go again. At the inception date, the present value of the lease payment amounts to at least substantially all of the fair value of the underlying asset. Okay, so to answer that question, we will say the following. Okay, so you will say the present value of the lease payments amounts to 230,000 Rand, while the fair value of the asset is 235,000 Rand. This is substantially all of the fair value of the underlying asset. Okay, so what we conclude, therefore, the lease is classified as a finance lease. Okay, so you can see what we went through over there. The question asked us, so let's take a step back. The question asked us for what? The question asked us to determine whether the question said we need to classify this lease. Okay. So when you're dealing, the first thing when you want to come with a lease, or we're dealing with a lease question, is to identify who are you dealing with. The lessee or the lessor. Okay, so we were dealing with Turner. Who is Turner? Turner is the lessor. So it makes sense that they're asking us to classify the lease, because when you are the lessor, the first thing the lessor has to do is to classify its lease. The lessor could either classify its lease as a finance lease or an operating lease. Okay, so how do we get to that? So we will first test whether it is a finance lease or not. Because if it's not a finance lease, only then can it be an operating lease. So therefore, we're going through the criteria for a finance lease. There are those 5 criteria, okay? Now remember, those 5 criteria, if one of it is met, then it is a finance lease. But in this particular question, we needed to go through all 5 because it told us, discuss it in terms of a finance lease as far as possible. So although the first line already told us it is a finance lease, we still needed to go through all the criteria to determine, because we needed to go as far as possible. So here, the ownership of the asset is transferred automatically finance lease, but we couldn't stop there. We needed to test everything else. So there's no option to purchase, but like we said, it is being transferred at no cost. So in effect, it is also meets that. The lease of the underlying asset is 3 years, which is 3 out of the 4 economic life. So basically, it is a major part of the economic life. So once again, what is major? Mean that is subjective. Okay, so we concluded that 3 out of 4 is major. Maybe more than 50% is major. I don't know. Then the present value of the lease payment, we left that for last. Okay, and then they say the asset is of a specialized nature. In this case, the asset is of a specialized nature. But is it so specialized that only Impact can use it? Well, we don't know from the question. So that is why I'm telling them that it is specialized, but it's not clear whether or not it is so specialized that only Impact can use it. Because I would think a drilling, almost any company in this industry would be able to use that drilling equipment. So perhaps it is not as so specialized that only Impact can use it. Okay, but then we have a look at the present value of the lease payments. Okay, so they're saying the present value of the lease payments substantially equals almost the full fair value. So what I'm saying here is that's the fair value, that's the present value. It's basically the full amount. Okay, so therefore we needed to work out the present value. And what I wanted to draw your attention to is the following. That the fair, in a lease question, you're probably always going to have to calculate this over here. Okay, so make sure you know how to calculate the interest rate implicit in the lease. Okay, so make sure you know how to calculate the interest rate implicit in the lease. You're most likely going to have to always calculate it, lessee or lessor. Okay, and then make sure you can work out what is a finance or what are lease payments. Okay, for a lessor. So this is the definition of lease payments. Okay, so it includes all of those amounts. Very, 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 very important. So we did that to get to the present value of lease payments, which happens to be 230,000 rand. Okay, so that is for part A. I'm going to give you 5 minutes to think about it, and then we're going to go on to part B. But before that 5 minutes start, do you have any questions you want to ask me at this point? Let me just stop sharing quickly. Sarika, you have anything that you want to ask?
The only thing that I'm now a little bit confused about, when I input these values on my financial calculator, I get the interest rate implicit of 4.2%.
How do you get
so,
that? Okay,
so basically what it is,
I think I know what that could be. So if you, which financial calculator are you using?
I'm using the Sharp.
Okay, so I don't know about how Sharp works, but if you press clear all, it must be important to make sure that your financial calculator is set to 1 payment per annum and not 2 payments per annum.
Okay.
I don't even know how to check that. I know how to check it on the other one. What's the other one called?
The HP.
HP.
Yeah, the HP. Okay, maybe I'm just gonna play around a little with it because I'm not too sure.
The fact that you're getting 4.2 is telling me that the first thing I can think about is that your payments per year is set to 2 per year and not 1 per year. That is what I'm I'm guessing.
Okay.
I do.
I'm not too sure how to check
You
or
see,
to actually change
so
it on my side. But okay, I understand everything like the way you went through the
you see,
questions,
if I do
so
that
I'm
over
okay
there,
with it.
if I divide it by 2, I get more or less that. So so you most likely on 2 per annum. So you must.
Hmm.
I don't know how to change it on Sharp.
Okay.
I
No,
mean, I
then
don't
it's
know how to
fine.
check events. So
Mm.
generally on the HP, if you press clear all,
Yes.
it will reflect what is the payments per annum. I don't know if Sharp have something same. So maybe you press clear all, see what if it shows the number of payments per annum. But you'll
Mm.
have to change that. So what's important
Okay.
over here is that you must make sure you know what constitutes lease payments and how to calculate interest implicit in the lease using the information that is given. So
Okay.
what goes to future value, what goes to fair value, what goes to present value, what goes to future value, what goes to PMT. Okay, so it's very
Okay.
important. Okay, let's take a 2-minute breaker. 20 past, we go on to question 2. Okay, it's quarter past now, so 4 minutes, then we go on to question 2. I'm just giving 2 more minutes. I'm now back. Okay, so this is a finance lease with a dealer manufacturer situation. Okay, so what we're going to do, I'm first going to show you how it would look if it was just a normal finance lease without a dealer aspect. Okay, then I'll show you a normal scenario of a normal sale as a dealer without a finance, and then we will combine them together. Do you see Excel? Let me just make sure you can see Excel. Okay, you should be able to see Excel.
Yes, I can see.
Okay, so the normal finance lease, a journal would have. Okay, so let's explain from the concept of finance lease. When we have a finance lease, the accounting standard basically states that you have effectively sold your asset to the lessee. Okay, so basically you need to de-recognize your asset, and you need to so you basically need to de-recognize your asset, and because you effectively sold it. Okay, so you must basically do like a sale transaction. So think about it as follows. If you had to sell an item of PPE, okay, what would have happened? We get rid of an asset at carrying amount. Okay, so we get rid of an asset at carrying amount. Carrying amount is cost less accumulated depreciation. So in normal circumstances, the journal entry would look as follows. Okay, so if it's not a finance lease, if it's just a normal sale of PPE. So let's assume we sold it for cash. What's happening? If we sell an asset for cash, we're receiving money. Money is bank. Bank is an asset. Bank is increasing. Assets increase on the debit side. So we would say debit bank with whatever amount. Okay. Okay, so we'll debit bank SFP. Okay, let's just assuming we're selling it for 300,000. Okay. But so that is what we'd have done. Then we must get rid of the asset. So because an asset is decreasing, an asset decreases on the credit side. Which asset is it? It is PPE, SFP. Okay, so we're going to credit it with, let's also just say 300. Okay, the cost price is 300. And then we must get rid of the accumulated depreciation. Accumulated depreciation is a negative asset. Think of it like that. If an asset decreases on the credit side, a negative asset will decrease on the debit side. So we go accumulated depreciation. Okay, let's just SFP. Let's just assume it is 100. Let's just assume it is 50. Okay, so now the journal is somewhat done. So if we add this up, if we add it up, it is basically that. So we can see the journal is not balancing. So we need to balance the journal. And basically, we need to put a 50,000 Rand over here. There's 50,000 Rand out. So we put a 50,000 Rand, and that is basically profit on sale. Okay. P&L. That's a normal circumstance. How would have done the calculation? Proceeds, carrying amount, profit or loss. Okay, so the proceeds 300, 1, 2, 3. Carrying amount, cost price minus accumulated depreciation. And basically the profit would be proceeds minus accumulated minus carrying amount, which is 50,000 Rand. Okay, so you recognize this from accounts 1, accounts 2, basically. You happy with that?
Yes.
Okay, so you're okay with that, right? It does you do recognize
Yes.
it from even high school, right? So
Yes.
so that is basically what's happening, right? So from a finance lease perspective for the lessor, this is the same concept that is happening. The only thing that is different is the following. It is this aspect over here, the bank. We're not physically receiving cash, okay? We're basically providing them with finance. So we are basically providing them with finance. So all that is going to change is that bank aspect. All we are doing is we're not reselling the item for cash. We are selling it on credit through the finance lease agreement. That is what finance leasing for the accounting treatment for a lessor is. Okay, so the bank amount is going to be replaced by two line items. It's going to be replaced by a gross investment in lease, for short, GL, and the other one is unearned finance income, okay, for short, UFI. Okay, so that is basically what is happening over there. So I'll take you back to the accounting standard to show you what is gross investment in lease, to show you what is unearned finance income. Okay, so we go back to the accounting standard. We're going to go to appendix or to appendix A, which is the defined terms. Okay, so basically this bank amount we're going to replace with that. So I want you to think in that sense. I want you to think in that sense so that you so you don't get confused in an exam, right? Just train your brain to think that a finance lease is effectively a sale of an asset. The only thing that's different from the sale of an asset is that bank part. In a sale of asset, we generally sell for cash. In this case, with a finance lease, we are selling an asset, but not with cash. We're selling it on credit through the finance lease contract. So all we are doing, we are replacing the finance, the bank part of the journal entry with two journal line items. Okay, so if you can get that straight in your head, then you will realize you can get 100% for a finance lease question. Other than obviously getting the numbers correct. Okay, so now let's go to what the definition is of gross investment in lease. So gross investment in lease is the lease payments receivable by a lessor under a finance lease, any guaranteed residual value accruing to the lessor. In this scenario, there's no unguaranteed residual value, but we know what the lease payments are. Remember, it is the lease payments, not the present value of the lease payments. Very important. It's the lease payments, not the present value. Okay, so it's the gross. That's why it's called gross investment in lease. The word gross means we are not making any time value of money adjustments. Okay, so it is the physical lease payments, and it is so remember, it's the lease payments that we're going to receive. Okay, very important. Remember, what is the definition of a lease payment? It has four aspects. The lease payment is the fixed, the variable, the guaranteed residual value, and any termination. Okay, so very important, and an exercise price. So therefore, the gross investment in lease is as follows. The gross investment in lease is 80,000 times 3 plus 10,000 Rand. Okay, so this is going to be 80, 1, 2, 3 plus 10. I mean 80 times 3 plus 10. Okay, so the gross investment in lease is 250. Okay, the unearned finance income, UFI, equals GIL minus net investment in lease. Okay, so let's go have a look. What is the net investment in lease? I mean, what is your UFI? So we'll probably come to net investment in lease first. So we'll read as we come through it. So the net investment in lease is the gross investment in lease discounted at the interest rate implicit in the lease. Okay, so basically the net investment in the lease is that present value of lease payments. Okay. Where is this? Oh, sorry, this is the wrong one. So the net investment in lease is basically the number we calculated above. I mean, yeah, it's basically that 230. Okay, so the NIL is equal to the present value of the lease payments. Okay, so just take note of that. Okay, so the net investment in the lease is basically the present value of the lease payments. Because what is the net investment in lease? It's the present value of the gross investment in lease. What's the gross investment in lease? This here is the gross investment in lease. Okay, so if you add this up, it comes to 250. That's the gross investment in lease. What's the net investment in lease? It is that. Okay, so just be aware of that. So therefore, UFI is basically 250 minus 230. So all we're going to do, what you must understand, the gross investment in lease is an asset. The unearned finance income is a liability. Okay, so we're going to do that, 250. And so this over here must equal, this over here must equal to the net investment in lease, which is, so we always disclose the net investment in lease, but the net investment in lease is made up of two things, gross and unearned finance income. Okay, very important to take note. So the journals to get net investment in lease is through the gross investment in lease and the unearned finance income. Okay, so in this case, we'd have made a loss. In this case, we'd have made a loss. We'd have made a loss of 20. Okay, so basically it'll be like that. So just take note of that aspect. Okay, are you okay with this at this point in time?
Yes, I'm fine.
Okay, so the way you must think about it is as follows. Okay, we're not answering the actual question at the moment. I'm just taking you through a normal finance lease. So this is a normal finance lease. Okay, think of it in terms of selling an asset for cash. So you'd have the exact same journal entries over here, but this would have been bank. So for finance lease, all you're doing, you're replacing bank with net investment in lease, which is 230. But the net investment in lease is made up of two line items, an asset and a liability, gross investment in lease and unearned finance income. Okay, so that is basically what is happening over there. Okay, so if we had to put this would be 230. Okay, so it made up a loss of 20K, which we have over there. Okay, so just take note of that. So now we're moving closer now to our actual answer. So remember, this aspect is purely a finance lease. Remember what's our question about? a lessor that has a finance lease and is a dealer. Okay, so a dealer is if he was a pure dealer, like before they came up with the lease agreement, when they sell a drill, the journal entry look as follows. Okay, so okay, so basically a dealer, as they call it, it's just like a normal shop, like you're going to BMW, or you're going to a car shop. They like by my mom name that if an S Auto and you're buying a vehicle, all they will do is, and you buy it for cash, right? All you will do is would be when they make a sale, what's going to happen? They're going to say revenue or sales, and they're going to have bank. Okay, this is going to be SFP. This is going to be P and L. Okay, so if this, let's say they sold the vehicle for 230, this would be 230. This would be 230. Okay, and then they would have cost of sales, and they would have inventory. Okay, so let's just say it is so this is P and L, and this would be SFP. Whatever the cost is, they just say 150, 150. That is basically what would happen. Okay, and then that's it. So in this scenario, we're gonna combine the two. Okay, so in a lessor lessor dealer situation, we're basically going to combine the scenario. Okay, so all we're going to do is combine the scenario. So what is happening over here? What companies do is the following, right? So they're struggling with sales. So what they would want to do is try to maximize the profit they can recognize immediately. Okay, as opposed to recognize profit over time. With a finance lease, you recognize stuff over time. Okay, so when they have an artificially low rate, so have a look over here in the scenario. Have a look here at the scenario. The market rate is 22%. This year is 18%, 4% discount. But if you look at the actual scenario over here, the rate, no, this is not R1. The rate in the lease happened to be, how much did it be? 8%, right? It's artificially extremely low. So that would then result in them realizing big gross profit upfront. So remember the gross profit over here, revenue less cost of sales would be that 70,000 rand. But if they, with the artificially low interest rate, this would probably be like, let's say they'd be able to recognize a gross profit of almost double the amount, for example. So to not skew that, the accounting treatment came up with certain guidance. So let's go have a look at the guidance, and I'll show you how we put the journals together. I remember. I need to just scroll through. Yeah. Manufacturer or dealer lessors. So here they're saying, at the commencement date, a manufacturer or dealer shall recognize the following for each of its finance leases. revenue being the fair value of the underlying asset, or if lower, the present value of the payments accruing to the lessor discounted using a market-related interest rate. Okay, so we have to do a new calculation for the present value of the underlying asset using the market-related rate. Okay, so what I'm going to do is I'm going to copy what we did in number 1, just change the rate. So they're saying, at the commencement date, a manufacturer or dealer lessor shall recognize the following for each of its finance leases. Revenue being the fair value of the underlying asset. In this scenario, the fair value of the underlying asset is 235,000. Or, if lower, the present value of the lease payments accruing to the lessor discounted using the market-related interest rate. Okay, so let's have a look. Let's go back. So I'm going to copy this over. These numbers will remain the same, but the rate will change. Okay. So I'm going to copy this over here. The rate will change. Okay, so we're going to change this to 22%. Okay, so my comment over here is going to be market rate. Okay, so what is the total present value? 220. Okay, so fair value, present value, so that is 235, and that is going to be that. Okay, happy with that?
Nice.
Okay, so what we're going to do, all I'm going to do is over here, I'm going to call this working one. So we're going to have debit, credit. I'm going to put in a revenue over here. So which number would revenue be? That or that?
Present value? No?
Why?
No.
Okay, so the reason, revenue recognized at lower of fair value and present value. Let's go back to what the standard says. Lessor shall recognize the following for each of its finance leases. We have one finance lease, okay? Revenue being the fair value of the underlying asset. Okay, so revenue being the fair value of the underlying asset, which is 235 over there. Or, if lower, the present value of the lease payments, discounted using a market rate of interest. Okay, very important. So have a look over here. We worked out the present value. We worked out the present value of the lease payments over here in question 1, and it came to 230,000. But the present value over here is coming to 204. Why the difference? In number 1, the discount rate used is the interest rate implicit in the lease. In number 2, when it's a dealer lessor situation, the discount rate is the market-related rate. So those are the type of stuff you want to be thinking about. Okay, so for example, at the end of this question, you must go back and say, okay, we discounted the lease payments in question 2. We discounted the lease payments in question 1. The lease payments in question 1, the lease payments in question 2 is exactly the same. Yet, the present value differ. Okay? Why does it differ? Because the discount rate differ. Why do the discount rate differ? Because in question 1, when we work out the present value of lease payments, we must use the rate implicit in the lease. In question 2, the discount rate used over here was the market-related rate. Why are we using the market-related rate? the market-related rate is because we are recognizing the journals for a lessor-dealer situation. And when we have a lessor-dealer situation, the revenue must be recognized based on the market rate of the lease payments. Okay, so just take note of that.
Okay.
If the fair value was lower, then we recognize fair value. But they told us, recognize fair value, but if the present value is lower, use the present value. So you're happy with that? Okay.
Yes, understand.
Now let's go back to the accounting standard. So we did part A. Revenue being the fair value of the underlying asset, or if lower, the present value of the lease payments using the market rate as discount rate. The cost of sale being the cost or carrying amount, if different, of the underlying asset less the present value of the unguaranteed residual value. Okay, so the cost price. Okay, so let's go back over here. So remember, there will be two journals: cost of sales, inventory. Because remember, it is a dealer lesser. It's a dealer lesser. We must recognize cost of sales because we'll have inventory, and we have to de-recognize inventory. The inventory one is easy because they told us over here the drill was manufactured at a cost of 180. So inventory sitting at 180. So we will get rid of inventory at 180. Okay. Given cost of drill. The cost of sales, they're telling us what the cost of sales must be. Cost of sales must be the cost or carrying amount, depending, of the underlying asset less the present value of unguaranteed residual value. So over here, the cost price must be cost less present value of unguaranteed residual value. In this question, there's no unguaranteed residual value. Okay, so therefore, this is going to be 180 cost price minus 0, because there's no unguaranteed residual value. Okay, you happy with that?
Okay, yes.
Okay. Then they say the selling profit or loss being the difference between revenue and cost of sales. Okay, so we're going to remove that inventory now, in accordance with its policy for outright sales, to which IFRS 15 applies. The selling profit or loss, in accordance with its policy for outright sales, okay, a manufacturer, dealer, or lessor shall recognize a selling profit or loss on a finance lease at the commencement date, regardless of whether the lessor transfers the underlying asset. Okay, so let's have a look. So let's quickly have a look at something here. Okay, so let's just quickly have a look. Yeah, so we actually, so if you have a look over here, the selling profit that they are making is as follows. This is basically the gross profit. Which equals that minus that. Okay, so that is basically the gross profit that they would be recognizing, 24,380. Okay, so we did the revenue and the cost of sales part. What we still need to do is the unearned finance income aspect. Okay, so what is going to be different over here? Okay, we still need to recognize the gross investment in lease and the unearned finance income. So let's quickly have a look at that. We still need to recognize, because remember, how are we selling revenue? In the normal circumstances, that revenue would have been what? That revenue would have been bank. Are you happy with that?
Yes, yes.
Okay, so that revenue would have been bank, but now that bank we're not selling it for cash. How are we selling it? We're selling it through a finance lease contract. So therefore, that bank amount for finance lease contract has to be this gross investment in lease aspect. Okay, so
Yes.
all we're going to do is do that. We're going to replace bank with gross investment in lease. Okay, so we're happy with that. Are you okay with that so far?
Yes, yes.
Okay,
yes.
so this would have been debit bank, credit revenue. They told us what the revenue must be. We worked it out. Okay, they told us what the revenue must be. Okay, so this here is working one. Okay, they told us what the revenue must be. We know what the gross investment in lease is. We calculated it somewhere. Calculated over there. And that over there. Okay, so I'm just going to cut this out quickly. I'm going to call it working two. Okay, so that's working two. Okay, so you're happy with that. At this point in time, this journal don't balance. Okay, so at this point in time, the journal does not balance. Let's just quickly have a look. But we'll do it in one journal. Okay, so we'll do it in one journal. The cost of sales. So that's this. The cost of sales will remain the same. Okay, cost of sales will remain the same. The inventory will have to be that. Okay, so let's have a look over here. This over there is that over there. Okay, it is the finance lease aspect. Okay, so just take note of that. So actually, let's just show you how we combine it. Because it's a lessor dealer situation, that is revenue. That is revenue. You happy with that? Okay.
Yes.
The question is telling us how to calculate. I mean, the accounting standard tells us how to calculate revenue, and we did that. Okay. In a normal revenue situation, we'd have recognized bank. But because we're not selling it for cash, we're selling it through a finance lease. The bank gets replaced with a finance lease aspect, which is that. Okay, and that's exactly what we did over here. So here we have the bank aspect, which is the finance lease, and there we have the revenue aspect, which is the revenue part. Okay, then we have cost of sales, because we made a sale, and there we recognize cost of sales, and we use the accounting standard to determine cost of sales. Okay, now in a finance lease situation, we'd have done this over here to get rid of an item of PPE, okay, a carrying amount. But in this scenario, we can't get rid of PPE because we are a dealer. So we are selling, we're in the business of selling drills. So we can't call it PPE because PPE is an item used in the production. But this is, we're selling something in the ordinary course of business. So that makes it inventory. And that's basically what we are doing over here. The inventory part, the inventory part. Okay, so in this scenario, that part falls away because we are selling inventory. We're not selling PPE. Okay, so that part falls away. And basically that part and the inventory part is kind of like the same thing. Okay, so you follow that. Okay, so we have covered revenue. We have covered cost of sales. We have covered inventory. And we have covered bank. Bank being this part over here. Okay. We have effectively covered PPE. We can't call it PPE because it's basically inventory, because PPE is used in the production of income, where inventory is sold in the production of in an ordinary course of business, and we are dealing in the ordinary course of business. The only thing that is missing from a finance lease perspective is the profit on sale. Okay. In a normal dealer-less situation, we would have revenue and cost of sales getting a gross profit. We have that over here. Revenue, cost of sales giving our gross profit part. All we are missing is the profit on sale aspect, profit or loss on sale aspect. So that is basically what we're going to bring in over here, and that would basically be the balancing figure. Okay, so I don't know what is the balancing figure. So I want you to take time to link. First, go through a normal finance lease, go through a normal sale, and then see how the two get combined. Then you don't have to memorize it. You're simply going to have use that in an exam to figure out what you need to do. But basically, the journal entry will always look like this.
Okay.
So you can see we are missing something. So the profit is 25,170. So the profit on sale of 25,170. That's basically what we are doing. So what most companies would want, they'd want that profit to be lower, and they'd want revenue to be higher, so that gross profit is higher. Because remember, a profit on sale goes through other income, where revenue minus cost of sales sit in the gross profit line item. Gross profit is far a greater indicator than other income. And that is why the accounting standard brings us out to reduce revenue. Because what they would have done, they'd have done this. They'd have done that, no profit, no other income, but this would have been 50,000 Rand as opposed to what it actually must be. Can you see gross profit over there is 50,000? Okay. But if I undo, gross profit is only 24,000. The overall profit is still the same. 50,000, but it's where it is split. Do you understand? So that is basically, and this comes to the conceptual framework in terms of providing information that is faithful, presented, as well as relevant. So having your gross profit number higher is much more nicer compared to having other income. So therefore, we need to make sure that those kind of classifications are accurate. So the way I suggest, when you revise this, go understand normal. What is a normal sale, right? And remember, I had here bank. But when we replace bank for finance lease, we make it those two line items. Then for normal dealer, they'd have recognized this. All we are doing for SO dealer is combining the two. You get what the accounting standard says revenue must be. You get what the accounting standard says cost of sales must be. This will be whatever it is from an accounting standard, as we did above, and then your missing figure would be profit on sale, okay, or loss on sale, whatever it is. Okay, so that's it from my side. My light is going to go off now. But yeah.